bring in Manish Singh from Crossbridge Capital LLP to join in and just explain to us what the thinking is today in the global markets. Manish, great to have you on the show. Can you give us a sense of what are the factors that US markets are looking at right now?
Hi, Tamanna. Good evening. I would say that the Ukraine factor remains because clearly there is no resolution at this stage. But one also has to be extremely careful that so far what we have heard from the authorities makes it very clear that the involvement of US on the ground is just not happening and is unlikely or very unlikely to happen. And that is a sort of assurance to everyone that at least the big economies are not going to get entangled in it. The second aspect is that we are looking at Federal Reserve meeting, which is in less than 3 weeks time from now, or about 3 weeks time from now. The inflation number and Federal Reserve, I think, are still the much bigger key factor that everyone is going to look at. And third, obviously, is what you mentioned just now, that there are signs that there could be some dialogue between Russia and Ukraine, and that should come as a welcome relief. But again, if it is at the condition that the Ukrainian forces surrender, then I don't know how far the talks are going to go if it ever starts, given how it is a very sticky situation for Ukraine to be in. So let's see what happens. But I would still say that the Fed and inflation factors will weigh more on the market than the Ukraine factor.
You know, if I'm just looking at the market now, and they're building up fairly strongly, the Dow Jones up about 252 points. So I wouldn't see a massive rebound, but definitely maybe some of those concerns are easing. Is there also a relief that the sanctions which have been put in are, enough to sort of keep the situation in bay, and the reiteration that the US will not go into a situation where they have boots on the ground?
Yes, that's absolutely true. If you'll see the one of the strictest sanctions that the UK had proposed, Prime Minister Johnson, was to kick Russia out of the SWIFT payment system. I mean, that didn't happen. I mean, that would have clearly be a major step. And if that was to happen, and it is not happening, as we know now, then Russia would react to it. There would be a tit for tat reaction, and that would lead to turning off the taps, energy supply to Europe. And that would really be in a catastrophic situation, given how dependent Germany is for its energy. And that would really ratchet everything up. I mean, even if you didn't have ground forces on the ground, the American forces on the ground, that would still be a very, 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 very dangerous situation if energy supplies were turned off. So thankfully, we are not there. And that will definitely be seen as a relief, because to kick Russia out of the payment system was vetoed by Italy, Germany, Hungary, and one other nation. So market can move on from there. If this becomes a regional localized issue, from what it looks like, because EU and US is not stepping in on the ground, then it just limits to what's happening over there. And then Ukraine will have to decide whether it gets to the table and has discussion about some sort of an agreement, which could be mediated by China or someone else. But if it goes down to negotiated settlement, that should again also be seen as positive. The only other thing I will point out is that if things get worse in Kiev tonight, if the Russian forces are on the ground and they clash with Ukrainian forces and this drags on, then that will have some impact on the market again. But I would not say that it will have a big impact. It may have some impact on energy, but not a lot. You saw yesterday the Brent moved up by 7%. The energy equities fell by 1%. So Mr. Market is giving you some kind of information that things have ratcheted up too far, and a lot of people do not believe that it will lead to a huge escalation.
It's maybe ironical. The market is seeing a positive cues in the fact that NATO and the United States are beyond a point, not really getting involved. And that is exactly what the Ukrainians are doing right now, feeling abandoned really by all of these forces. But I just want to broaden the picture, Manish, because we're talking right now about factors that the markets are looking at. Is Fed action, inflation concerns, things like that going to return to top of mind? Or is it sort of wait and watch? Difficult to predict right now what the next week will hold.
So the inflation factor remains. So you see the last CPI print in US was 7.5%. And that did not include a lot of factors like rent increase, because that is big part of the basket in US, and those numbers so far have been on the lower side. So if we see any uptick in that, then the inflation number could register higher, though there have been a lot of other positive things. If you look at the disposable income, that disposable income is now growing below trend after 3 quarters of above trend growth. And that is for the reason because there's plenty of saving, plenty of help from the federal and state government to the people. So that those savings are drying out, and that will have an effect on consumption. So there is going a bit of balancing act going on. I think that we are heading to a point where you will see a peak in inflation now. What that level is going to be is difficult to say. But if you look at the market sentiments, and I write this in my newsletter, which goes out today and it'll be on our website. If you look at the market sentiments, how negative it is today, it is almost where it was in 2016 when rate rise had started and you had one rate rise at that time. At that time, the market bottomed after the first rate hike. If the same pattern was to repeat this time, then I would expect the market to bottom end of March, early April, and from then on to steadily increase, because by that time you would have had two sets of data in terms of unemployment and inflation data, and one would know where we are positioned. So I think that's something to bear in mind. People who are bearish also have to bear in two factors. If this Ukraine situation de-escalates very quickly, then that'll be seen as a positive. If there is a turn in inflation number in the US, then that will be seen as a positive. So I do not believe that one can be very bearish given where the index are already. The S&P entered a correction territory and now it's up from there. The tech stocks, as you know, have been just going down since last September, October, with many stocks cut in half. So there is already a lot of pain in the market, even though it's not on the index side. So there is enough room for optimism to look at what's going to happen to going forward, and if not a big rally, then the relief rally and some sort of stability is there, nearly there for one to pick up the next long positions from.
Okay, that relief reflecting in Wall Street today. Nasdaq still under pressure. Thank you so much, Manish, for joining us today. Let us quickly tell our viewers what's happening in
My
the
pleasure.
markets.